Hello and welcome to Bangalore International Centre's very own podcast, BIC Talks. Bangalore International Centre is a platform for informed conversations, exchange of ideas, and a space for arts and culture. BIC Talks brings the essence of all that the physical space stands for and more to your doorstep.
The US Federal Reserve and its policies don't just influence the US economy, but also the world's. Since the COVID-19 pandemic hit the US, unemployment in the country has skyrocketed and remains at a historical high, with its percentage remaining in the double digits since the shock in April this year. On August 27, just a few days ago, the chair of the US Fed, Mr. Jerome Powell, announced some major changes in policy, indicating a strong focus on employment for the institution. Hi, I'm Pavan Srinath and welcome to BIC Talks. Joining us today to provide some much needed perspective on the US Federal Reserve, on monetary policy making, and on what's happening right now is Narayan Ramachandran. Narayan is a columnist, an emerging markets investor, and a polymath. He was here last on episode 5 of BIC Talks to explain how the pandemic's economic fallout would be made much worse by India's festering banking crisis. Narayan, welcome back to the show.
Thank you, Pavan. Delighted to be here and to be talking to you a few months into the pandemic. I think it'll give us an opportunity to revisit some of those conversations as well.
Absolutely. And dear listeners, today on episode 46 of BIC Talks, Narayan and I will mostly be giving you a background on the US Fed, on monetary policy, and what this means for the United States. In our next episode 47, Narayan will be returning to speak about what this big move by the US Fed means for India and emerging markets. If you're a concerned citizen, an investor in the stock markets, or have any questions at all, please share them with us before 3 p.m. on September 2nd, India time. Head on over to tiny.cc/BIC Talks 46, fill up a short form and share your question. You can even record a short audio clip and share it with us. If that doesn't work, please send an email to bic@bangaloreinternationalcentre.org. We cannot wait to hear from you and hope to have Narayan respond to your questions in episode 47. Narayan, before we get going to what's happening right now with the US Fed, most of us are fairly illiterate when it comes to macroeconomics, the actions of central banks and so on, though we see news about it all the time. So can you give us some context, some history, and some Macro 101, what has been the historical focus of the US Fed?
Since all good stories begin with a story, let me ask how many of our viewers have actually seen Alexander Hamilton. If they haven't, I would highly recommend it. There is actually a show on TV now that they can see in case they're not able to access the real thing because of the pandemic.
Yes, the one tiny silver lining of this pandemic has been coming of Hamilton on, I think, Disney Plus Hotstar. So I finally saw it because of that.
I would encourage all of those who are listening to this to actually see it. But one of the many very interesting songs that Alexander Hamilton sings in that and is charged with, if I could say, he establishes the so-called federal banking system as Secretary of the Treasury in the 1700s. So for those of you who want a story-based background to the story of the Fed, that's where it sort of all begins. I won't take you through the long history of the federal banking system, except to say from sort of those early beginnings with Alexander Hamilton, the actual birth of the US Federal Reserve took place a little over 100 years ago in 1913. And for a lot of that time, from 1913, the goal of the Fed was so-called financial stability, particularly because the last 50, 60 years from the mid-1850s was really focused on sort of banking crisis one after the other. And there was this need for stability. So born from this need of stability was the US Federal Reserve as a federal banking system that would in some way address this. Now, fast forward to World War II. In the aftermath of the end of World War II, which was in 1945, the Federal Reserve sort of started rethinking its own objectives and its purpose, if you will, in the context of putting back lots of the soldiers who were coming back from the war back to work. And so the Federal Reserve had this emphasis, if you will, unstated almost to some extent, but certainly widely discussed in Congress and other places where it had a focus on employment.
So, Narayan, you're saying before that the focus was not even so much on inflation or something like that, but on stability of the banking sector. That was its historical focus.
Easily till the end of World War II, the goal of the Fed was really on stability in all senses of the term, but most particularly related to bank runs and things of that nature. The lender of last resort was a known concept, but concepts of inflation and money and all were much less evolved. There were colorful characters, like a character called Irving Fisher in the early 1900s, who actually, is some senses is credited with inventing mathematical economics, who went on to first become a multi-millionaire in those times and then ending up losing it all in the 1929 crash and so on. So they were obsessed with this boom bust kind of scenario that was taking place every several years. And they were trying to bring stability in that boom bust era, if you will. So that's the real historical context. Subsequently, after World War II, they stumbled on employment being a necessary thing because all of these people, young men in particular, were returning from the war. And it was important that all institutions of government would in some way offer some sort of help to employ these returnees from the war. So that's how the initial concern about employment began. Over time, though, what happened, Pavan, is that this worked reasonably well in the 50s and much of the 60s. As you know, the US was in a long expansion. And broadly speaking, employment and inflation and many of the other parameters were well under control. So one could say that this was actually working, so to speak. But then in the early 1970s, we had the first oil shock. And as a consequence, we had the beginnings of what is now called stagflation, which is stagnant growth, but inflation. And so in 1975, the Fed had got from Congress a new mandate. And that new mandate is now famously known as the dual mandate. So let me just read the Fed's own words related to this mandate, if I may, Pawan. The FOMC, which is the Federal Reserve Open Market Committee, which is that part of the Fed that is charged with maintaining this monetary policy of the Fed, says the FOMC is firmly committed to fulfilling its statutory mandate from the Congress of promoting maximum employment, stable prices, and moderate long-term interest rates. The committee seeks to explain its monetary policy decisions to the public as clearly as possible. So if you want to think about it, there's actually 2.5 objectives in there: maximum employment, stable prices, and I would give a half to moderate long-term interest rates. And then as an adjunct, it says the committee seeks to explain its monetary policy decisions to the public as clearly as possible. So this is the notion of transparency and clarity, because through transparency and clarity, you engender trust and credibility. And the more trust and credibility that the Fed has, or a central bank has, the more it is able to deliver on its objective, because whatever it does has the intended effect under a regime of trust. So, I mean, those are sort of the operating principles, if you will, under which the FOMC is fulfilling the mandate since 1975 on maximum employment and stable prices.
So, Narayan, this practice that we see now in India, in the US, and elsewhere of regular statements to the press, regular public interactions from central banks of various sorts, does that stem from this move in the 70s? Is that when this process became a lot more transparent?
At that time, the Bundesbank from Germany and the Fed, in a post-war period, there has actually been a lot of literature, not so much on the monetary operations, but on the communication by central banks. And the scholarly discussions related to that all suggested, I would say sometime beginning in the 50s and 60s, that transparency and clarity were a very, very important element of the conduct of policy by central banks. And so, yes, I would say that it became common practice, probably in the Bundesbank starting in the late 60s and in the Federal Reserve starting by the early to mid 70s, if you will. Yeah.
I sort of get the link intuitively that a central bank, a lender of last resort, can take actions that can influence inflation in the economy in one way or the other. But you said that the first mandate since World War II was employment. How does a central bank or a US Federal Reserve even influence employment? For people who are not students of macroeconomics, could you spend a couple of minutes on that idea? And now that there are the twin mandates, how does one balance them?
Like everything in economics, there is a trade-off. And the trade-off between employment and inflation was actually famously discovered by, or illustrated, I might say is the right word, by an economist called Phillips in the UK. Phillips wrote some initial observations and then codified this into an article, I think in the late 50s, maybe 1958 or so. And it has become famously known as the Phillips curve. And what the Phillips curve essentially shows the relationship between employment and inflation, and it shows an inverse relationship between unemployment and inflation, which is that as unemployment reduces, inflation rises, right? And so you can think of a chart that's like an open parabola, right, with the left going up and the right going down. So that is, as unemployment reduces in an economy, the inflation goes up. Now, this Phillips curve was at the center of the debate in the 70s and is now again in the center of the debate, because what is happening is that rather than a continuous curve between unemployment and inflation, it looks like there is a sort of a point up to which you can push down unemployment or push up employment, which has no obvious inflation impact. So this is the sort of the birth of the famous concept of NAIRU, N-A-I-R-U. It is called the non-accelerating inflation rate of unemployment. It's a bit of a mouthful, but what it simply suggests is that up to a certain threshold, you should work on inflation rather than employment. Only after a certain threshold, perhaps unemployment begins to impact inflation is sort of the idea. But the Phillips curve had started failing, or at least was held in suspension, if I can say that, in the 70s, when both unemployment and inflation were high. So stagflation was not an anticipated sort of economic scenario. And in that economic scenario, both were high. So you think of it, the inverse relationship did not hold in the 70s. Now we have the opposite issue. So prior to the pandemic in the US, for instance, as many of our listeners will know well, US unemployment was at a historical low. And despite that, inflation was not necessarily at a historical low, but was very low and quiescent. It was non-worrisome, if you want to call it that.
And by Indian standards, extremely low, right? And we think of the dollar as a very, very stable currency, and it's the Indian rupee that might be sort of changing in its value against that dollar.
The Indian history is a long and complicated one in itself. Of course, there's many points of interrelationship, and we can get to some of them. But just sticking with the US for a moment, I think the Phillips curve has been in and out of favor. But given the dual mandate of the Fed, they have retained it as an instrument of policy, so much so that they have continuously said that if inflation rises above 2%, and then the actual numerical value of inflation is 2% from a Fed's point of view, they will actually intervene and will cut it down. Now, that is the context of today and the context of the particular change that we will come to in a second that was announced a few days ago, as you said, Pavan. But what most people may not remember is that in the 70s, under Fed Chairman Paul Volcker, interest rates sort of averaged 11%, I'd say in 1979 and 1980. And at that time, the bigger issue was the lack of confidence arising from inflation in the economy. So Volcker came in and famously increased interest rates to a peak of about 20% in 1981. And in that process, the word that everybody uses is broke the back of inflation in the US and began a long run expansionary boom based on low inflation. To some extent, we see the positive effects. There were some negative effects, which I'll get to in a second, but the positive effects of lower inflation and longer expansions began when Paul Volcker broke the back of inflation in beginning in 1981. 1982. By the way, most people forget that Volcker was actually appointed by a Democrat, Jimmy Carter. Of course, he was reappointed by Reagan. So it was not a right-wing or left-wing conspiracy. It was simply that the received economic wisdom shifted to tackling inflation in a strong way because it was the thing that was causing the most problem. Now, one of the consequences of the Volcker decision starting 1979, actually, I think the interest rates went up in 1981, was that the US went into recession in 81-82. Partly to address that and partly given the fact that the US was already aging demographically, Ronald Reagan started a very long fiscal expansion program starting about then, which has continued through the ages for the last 30, 40 years and has resulted in the magnificently large debt burden that the United States carries today, which we'll talk not about it in the inflation context, but about the deflationary context of that in just a second. So that started that wave, if you will, of making sure inflation is low, but on the other hand, given demographic needs and fiscal expansion, the debt side of this became large. So if I were to summarize the sweep of post-war history, the first 25 years of the Fed were broadly focused on maximizing employment. And the next 40 years or so, starting with Volcker all the way up to now, has focused on price stability with a particular emphasis on an inflation rate of 2%. And the announcement, and I'll just turn the mic back to you with that, is the announcement this last week is historic because it sort of signifies that the pendulum has now swung back to employment from price stability and inflation. It doesn't mean that price stability has gone away. It just simply means that the pendulum has corrected the imbalance that was towards inflation perhaps for a little too long over the last 40 years.
Could I ask you to maybe spend a minute or two on just helping us understand what does inflation, an expectation of inflation, and various levels of unemployment rates mean for people in the economy? What does it mean beyond, Wall Street and the Fed and others? How does that affect the nature of an economy and society?
So I think this financialization is partly responsible for the focus on numerical aggregates that seem abstract to most people. But at the end of the day, virtually everything a central bank does, or certainly that a Ministry of Finance in any government does, should be understandable at the level of a household. So in a way, what it is saying is, and take the concept of inflation expectations, which is one of the major innovations in economics over the last several decades. Think of inflation expectations from the point of view of a household. What a household says is, hey, listen, if I think that the prices are going to keep rising, then I will do whatever I need to do today and I will conserve cash for that moment for later because I know these things are going to go up. So at the macro level, it's simply take that household and multiply by millions of households. That's literally what is happening with the concept of something like inflation expectations. A very similar concept happens with either wealth effects, or debt. So there is only one macroeconomic aggregate that is different from a household, and I'll come to that in a minute. But it works exactly the same way. Think about a rich uncle and a poor nephew. The poor nephew can keep borrowing to the rich uncle until the rich uncle decides that the poor nephew is a bad credit, right? Global economies and emerging markets work almost exactly the same way, because the moment that rich uncles and others who are lending to the emerging market through the capital account sort of decide that the emerging market is not worth focusing on, You have all kinds of crises that come from that money being withdrawn, right? The only macroeconomic aggregate that is different is that an economy, particularly a sovereign economy, prints its own money. And in that sense, it can deficit finance, right? So, of course, if you do it beyond a point like Zimbabwe did, then you get into hyperinflation. But at least up to a certain point, a sovereign economy can print money and in so doing can actually run a fiscal deficit. The concept of a multi-year fiscal deficit is not valid at the level of a company or at the level of a household. Unless you get some external financing for that deficit, you cannot be viable. Can't print your own money at a household level. But what Keynes famously showed is that it is a reasonably good solution if you have a dramatic demand interruption, as was the case in sort of the 30s in the Western world. So I would say, except for that difference, you should think of exactly what you do as exactly what a central bank is aiming to do. Now, the difference, of course, is that it has instruments. It has many instruments that we don't have at the level of household, everything from open market operations to the ability to buy and sell all kinds of bonds and things like that. So those instruments and the sophistication with which you can manage those instruments is different.
And here, the idea of, say, inflation expectation, both for households and for companies, can mean a lot, right? So if, for example, there's a lot of uncertainty in how much inflation there might be a year from now, that will affect businesses wanting to invest. It will affect individuals wanting to purchase assets, spend money, put up savings, all of that, right? So when you don't have this inflation expectation that can be manageable, then people don't know how to take smart decisions that can benefit themselves. Is that broadly correct?
Absolutely correct, which is that both the level, just is the inflation high or low, as well as the volatility, the rate of change of that high or low, impacts lots of decisions. In the same way that it impacts a household, it impacts a company because they postpone their cement factory or their juice factory for another day because they're not only not sure about the level of inflation, but the rate at which it will change. So the volatility of inflation is yet another discussion we can have for another time, but both of those do impact investment decisions, and by impacting investment decisions, they have significant impact on both economic output and aggregate demand.
So with that, if we come to the last decade or so, we had the global financial crisis and now we have the pandemic creating a new financial crisis across the world. What has that meant for the US Federal Reserve and central banking? How has the nature of the game changed?
So the nature of the game has changed quite dramatically. As again, many of you know, the period post the global financial crisis has been called the Great Stagnation or secular stagnation, where this is characterized by sort of anemic aggregate demand, high debt, and low interest rates. And except to some extent in the United States, starting about 2017 onwards, and maybe China a little bit in the early part of the decade, this has been the characteristic of pretty much the entire decade in virtually every economy, and particularly true for Europe, Japan, and so on. So low aggregate demand, high debt, low interest rates, sort of the great stagnation over the entire decade. And into this, we have this exogenous external shock coming from the pandemic, which completely annihilates demand. So we already had low demand, and now you have catastrophic decline in demand, which flexible economies like the US immediately respond. And Pavan, right at the top, you mentioned that unemployment rate was off the charts. It was because the immediate response of the economy is to say, hey, listen, demand's gone from 100 to 10. The thing we have to do is to cut at least labor supply from 100 to 50 or 100 to 40. And that causes a dramatic decline in employment. But what happened through this entire period, at least in the US, which measures this thing very carefully, is that even as growth returned to semi-normal, and some of you will remember that 2017 was a year of synchronous growth in the developed markets and the world and the emerging markets, even as growth was normalizing, so to speak, in the world. Of course, India shot itself in the foot with demonetization in 2016. But even if you take that sort of to the side, even India was normalizing in that period. And as they were normalizing in the US, inflation levels were peaking at lower and lower rates. So first phase of it, they peaked at about 1.8%. And then the second was about 1.6, 1.7 just before the pandemic hit. So it was almost as if the ceiling on inflationary pressures was tapping itself out. The very first time that inflationary pressure started surfacing, the US, under its old paradigm, started reacting. And Pavan, you will remember the famous term taper tantrum in 2013 in India. And that taper tantrum effectively was the Fed implementing its 2% inflation consideration, threatening to implement its response action to 2% inflation. Subsequently, they didn't do much of it. It sort of mellowed out to the synchronous growth of 2017. But 2013 was a scary year, if you will remember, when the rupee dropped precipitously and aggregate demand was hit pretty much across the emerging markets. So that is the context in which we are now at today. And what Fed Chairman Powell said 3 days ago at the annual Jackson Hole conference is that the Fed will now pursue a goal of average inflation of 2% rather than react and respond and even be expected to react and respond with a point estimate of 2%, which sort of means they have given themselves a lot of flexibility on the inflation front. We will have lower rates for longer. And to use a colloquial term, you will have to see not only the whites of inflation, but truly inflation expectations get 2% and over before the Fed will react to stop inflation again, which sort of translates to the taper tantrum is unlikely in the next 10 years, or at least in the next immediate future, because the Fed will be more focused on anchoring inflation expectations north of 2% rather than reacting to it well before it gets there.
So does that mean that then they will be looking at employment a lot more and moving in response to that, so long as inflation broadly stays in this 2% regime, plus or minus?
Exactly. So the technocratic justification, if you will, is that they now have the ability to do other things. And other things is, of course, employment from the point of view of the Fed. But they are getting this greater ability to do other things because they have a much less elastic Phillips curve. We spoke about the Phillips curve. And let's just say more benign issue related to price stability. So what they are saying is we now have more tools and more cushion to focus back on employment as the primary objective. Of course, they have to do it with instruments that are primarily related to interest rates and things like that. But let me give you a for instance on how, and you had asked this question earlier, Pavan, how the Fed might, quote, focus more on employment than on inflation, right? Very soon, in fact, even as you're putting this podcast out, it seems rather likely that the second big fiscal package from the US Congress will be approved. And that fiscal package will have 4 elements. It will have a continuation of the PPP, which is the Paycheck Protection Program, right? Which was quite helpful in the first phase. So that's one. Second, it will have a reasonable amount of supplemental unemployment insurance. As you know, the Republicans and the Democrats have been fighting over whether that should be $200 or $600. I think the compromise that is going to most likely come into effect is that it is going to be $600 as it was, but that $600 is going to be applied for a shorter period, perhaps through the end of the year. The third is that the existing program of unemployment insurance continues. And the fourth is what Milton Friedman and then subsequently Ben Bernanke called helicopter money, which is just a check in the mail through the tax records will actually, again, they did this once already. Many people received $1,000 of a check. Many people will receive it again. Now, historically, when this kind of fiscal expansion would take place, the Federal Reserve would be a very reluctant participant and would basically say governments are acting irresponsibly and government should focus on inflation and not simply on fiscal expansion. Whereas this time, it seems rather likely that the Fed will actually coordinate fiscal expansion in order to generate better employment prospects and ensure the existing unemployment prospects through the unemployment insurance system.
So basically, even if the government is therefore printing more money and spending it more, the inflationary effects will not be countered by the Fed with as much vigor and rigor, right? I mean, they'll allow that to happen so that it benefits job creation and job growth.
Exactly. And if you think about further instruments, the even further instruments are that actually the Fed can buy US bonds and actually retire them. So that is actually directly monetizing debt. So if you think that debt is too large, one instrument that the Fed has is that the Fed becomes quite literally the buyer of last resort, not the lender of last resort. And it buys and actually settles that debt with the government. And in so doing, the historical view would have been that is highly inflationary. But the tolerance to that would have increased more through this particular sort of change in paradigm, if you will, at the Fed, if you get my drift there.
I mean, usually we see when it comes to things like inflation, the central bank keeping the government in check, right? So here, if the two start working together, do you see this working out well? Do you see this as necessary evil? Or how do you see this in the current moment for the United States? Let's begin there.
Yeah, I mean, I think you'll get all kinds of opinions on that one, but I think the mainstream received wisdom today will be that it is a necessary evil and that it is the only way to get out of the anemic progress we would otherwise make. We are making anemic progress ever since the global financial crisis, for the reason of high debt, low interest rates, and low aggregate demand. Nothing sort of shifts that dynamic and persuasively and structurally. And therefore, in an aging demography, where even export destinations are also aging, there may be no choice but to do this. So in a way, and economics is always sort of attempts to answer this question, what is the least imperfect solution? And at least from the point of view of a developed market that is aging in demographic terms and anemic in the terms that we described, this is sort of the least imperfect answer, is sort of the way I would put it.
If we are looking at, some sort of a vaccine, some sort of a solution where we start addressing the pandemic within the next, 12 to 18 months, do you see this move from the Fed putting the US economy in a position where they can bounce back and take advantage once we are able to manage this pandemic?
Yes, Pavan, I actually do believe, and I don't even think it's 12 to 18 months, potentially sooner than that, if the pandemic is under control, that this will mean a cyclical boost to the economy and to markets. And even though the markets have been led in the US with a very narrow group of stocks, particularly the tech stocks, I think you could potentially get in the middle of next year, or focusing on the middle of next year, a recovery that is based on this cyclical recovery in the economy. After the pandemic, we will have to analyze the world as emerging markets ex-China and China. China is already doing quite well cyclically, and given that it was ahead in the pandemic timeline, it is now responding very nicely in an economic sense, and most likely will have actually positive year-on-year output even beginning in the third quarter, to the extent of about 5% over the same time last year. So China is doing very nicely. And other emerging markets, for no fault or action of their own, will have a cyclical boost arising from sort of this emphasis shift. Now, this is good and bad because in a sense, it's a get out of jail free card for countries like India. So that keeps the pressure away from things like reform. But in a true sense, and in the sense of actually alleviating distress and so on, a cyclical recovery for emerging markets is actually a very positive thing. And this cyclical recovery, so long as governments like the one from India actually act during the cyclical recovery, we could make it a broad-based expansion based on sort of dovetailing reform into that cyclical recovery. So I would like to close on that positive note that the change in paradigm at the Fed and the very strong action by both the Federal Reserve and the ECB early on creates an environment of liquidity that the whole globe will benefit from in a cyclical fashion, so long as there is some sense of broad control on the pandemic. And that will give you a potential reasonably good 6-9 month period in 2021 that we can all look forward to.
Narayan, that is a note of optimism that I think we can all look forward to in these gloomy times. And thank you so much for coming back on BIC Talks. Dear listeners, a reminder. Our next episode of BIC Talks will have Narayan returning to the podcast to discuss what these moves mean for India, for emerging markets, our economy, and even for investors. And we want to hear what questions you might have. Share a short recording or type out your question at tiny.cc/BIC-talks46 or send them to bic@bangaloreinternationalcenter.org before 3 p.m. September 2nd India time. And thank you for tuning in. Thank you for listening in till the end. Please share this episode with a friend on social media, WhatsApp, or anywhere else. It would mean the world to us. And in case you're listening via iTunes or Apple Podcasts, please leave us a rating and a review. Subscribe to BIC Talks on email or your favorite podcast app and don't miss out on future episodes. This episode of BIC Talks has Gaurav Krishna as our sound engineer with support from S. Sarvanaraj and Lekha Naidu. And the accompanying episode artwork was made by Chandni Venkataraman.
Thank you for listening to this episode of BIC Talks. This podcast can be accessed on our website, bangaloreinternationalcenter.org, as well as on any of your favorite podcast platforms. Tune in for new episodes every week, and do subscribe to our YouTube channel and follow our Facebook, Twitter, and Instagram pages to stay informed on our latest updates.